Coming up on Market to Market, citrus farmers feel the squeeze of hurricane damage. Conflicting views on wildfire management, and how new pork processing plants could impact Midwest producers. Those stories and market analysis with Dan Hueber next.
Wherever your operation takes you, or who you share it with, we'll be where we've been all along. With you from the word go. Proud sponsor of Market to Market.
Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today. And by Sukup Manufacturing Company, offering a full line of grain drying and storage equipment and steel buildings. Sukup Manufacturing is on a mission to protect and preserve your crop and the tools that produce it. This is the Friday, September 22 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. Monetary policy, hurricane hangovers, and other key indicators crafted an economic brew to test the nation's mettle this week. Housing starts fell for a second straight month in August as the Commerce Department reported weakness in single-family home construction. According to the National Association of Realtors, existing home sales slipped 1.7% in August as the inventory shortage of the past 2 years lingers. Federal Reserve Chair Janet Yellen announced Wednesday, while the benchmark U.S. interest rate will remain in place, the Fed will begin downsizing their portfolio to unwind quantitative easing. And Creighton University's 10-state Rural Main Street Index fell to its lowest level of 2017. Some see Hurricane Maria, another violent weather system offshore, and Washington's rerun of Obamacare repeal, and they picture the movie Groundhog Day. But those who respond to natural disasters recognize the importance of a proactive approach to looming cyclical impacts. Paul Yeager has more.
The longer-reaching impact of Hurricane Irma is coming into focus. Florida agricultural officials said this week the storm could not have been more lethal to the state's farmers, and the scope of damage to fruits and vegetables in the Sunshine State is unprecedented. Fruit has started to fall from the citrus crop. The dropped oranges are turning from green to orange, leaving piles of ruined juice oranges in the field. Some longtime observers of the industry say the hurricane's damage will likely be more severe than any previous freezes, fires, or floods. Florida is the nation's largest juice producer, and some citrus farmers in the southwestern portion of the state say they've lost 80 to 90% of their crop. All of the cotton crop in the storm's path was insured. However, many of the farmers impacted by Irma and Harvey, hoping crop insurance would assist in recovery, are finding out their coverage may fall short. The number and type of crops covered by insurance has grown 86% since 2000, leaping from 325 to 551 crops this season. USDA Chief Sonny Perdue estimated damage to U.S. crops from Harvey could come close to a $1 billion figure. Interior Secretary Ryan Zinke also was dealing with natural disasters this week as he called for a policy change to prevent wildfires. A recently released memo revealed Zinke would like forest managers to think differently. The plan is to clear dead or diseased trees near roads or buildings and prevent fire from spreading. Forest fire experts say the policy would be tough to attain and is less desirable than plans already in place. A thinning policy may assist communities near forests, but much of this year's blazes are in higher elevations and wilderness areas. One environmental theory says prescribed burns do more to minimize future fires by reducing fuel than suppression efforts carried out with crews working by hand. For Market to Market, I'm Paul Yeager.
This week, Tyson Foods announced it will put plans for a Kansas poultry complex on hold. The company had pledged construction of a $320 million plant in Leavenworth County just 2 weeks prior. By midweek, more than a dozen other Kansas communities had lined up to take a crack at the 1,600 jobs the project was forecast to bring. Local rejection of industrial bond funding drove Tyson's move and adds to the contentious debate over corporate giveaways in Midwestern states. As producer Colleen Bradford Krantz discovered, the planned addition of a handful of hog processors also has brought mixed reactions from Heartland area producers.
By late next year, Iowa hog producer Rick Chipman should be able to point his livestock trailer in any direction and within 4 hours reach any of 11 hog packing plants.
We've been blessed with a lot of packing space in this area. Unfortunately, the industry as a whole needs more. We have pushed our packing capacity to its limit the last few years. And so it's a good thing that we see additional packing spaces open up.
Chipman, whose Chipman Farms near Harlan will feed out nearly 60,000 hogs this year, said he's cautiously optimistic about the 5 new or renovated Midwest hog processing facilities that will be open by fall 2018.
It shows the vibrance and the growth of the industry. We really like how companies and groups of producers are investing tremendous amounts in new technology and state-of-the-art facilities. We certainly like the competitive spirit that we have between the packers when we go to make contracts.
The 5 hog packing plants will ultimately have a combined slaughter capacity of at least 9.5 million hogs annually. That would represent about 8% of the 118 million hogs slaughtered in the U.S. in 2016.
The supply is already set on how many market hogs are grown. The demand is determined by how much people want to eat pork in the U.S. and how successful we are at exporting pork outside the country. That is not going to change as a result of new plants being built or not being built.
Prestidge Farms plant near Eagle Grove, Iowa is expected to open in November 2018, ultimately processing 10,000 to 12,000 hogs a day. According to Ron Prestidge, the additional plants should create more competition among packers for market hogs, which could make for increased producer profits in the Midwest, as the facilities aim to operate at capacity when possible. If the supply of hogs increases too rapidly, however, prices could dip instead.
We, of course, saw this happen in 1998, is when you run into a situation where you actually exceed shackle capacity, at which point packers really don't have to bid anything for hogs because they've already got all their shackles filled.
The new plants feature more robotics, snap chilling, and low-impact livestock handling, which may offer an operating advantage over older plants, primarily within the Midwest. Increasingly, pork plants are leaning toward vertical integration, with owners or partners supplying a larger percentage of the animals, rather than buying on the open market. The Prestidge Farms plant in Iowa plans to harvest some of its own hogs, but will buy open market hogs for about half of its first shift supply. If a second shift is added, those hogs will all be purchased from other producers.
The poultry industry has evolved to a point where it's almost entirely vertically integrated. I'm not going to criticize other companies that have moved towards a more integrated model. It's not really the big motivation for us. We've just seen a tremendous amount of consolidation in the packing industry and the pork business, and we kind of felt like for the health of the industry, it'd probably be good if there was a little more competition and some new packers.
In Windham, Minnesota, a group of individuals, including hog producers, spent nearly $70 million remodeling a beef packing plant that had closed less than a year earlier. Now open as Prime Pork, the renovated facility brought 300-plus jobs back to the community of 4,500 when it launched last spring. Company officials say 80% of the hogs will ultimately come from either plant owners or permanent suppliers. The ultimate goal is for Prime Pork to sell a consistent product.
All the hogs that we get from the 3 producers will be basically fed the same diet and have the same sire as far as the boar. And that is really the key to the customer, is to ensure that when you buy a pork chop today, it's going to taste the same today as it does a month from now.
Employees are already processing 3,500 hogs a day, but the final objective is to slaughter 6,000 a day by year's end. In Sioux City, where the new Seaboard Triumph Foods plant opened this month, officials said they will have to be particular when buying 1/3 of the hogs from independent producers. The company, which hopes to add a second shift next summer in order to process 21,000 hogs each day, wants to make sure those additional hogs also meet quality and traceability standards demanded by a global marketplace.
We're also pretty proud of the control and the quality that brings by having literally the ability to bring feed to the hog farm, to the processing center, to the package, and then delivering that to the customer. It generates a very high quality product. Our requirements with our open market hogs are that they're essentially identical in configuration, genetics, nutrition, animal care. All of those requirements are the same as if they were internally sourced.
Chipman understands packers need to meet the demand for consistency, but worries what it would mean for the industry long term if packers continued to raise more or all of their own hogs.
That's been a difficult thing for me to kind of chew through. And it would be very damaging to independent producers like myself, particularly if the shackle space was completely tied up. When I've approached packing companies in the past, they have seemed to want to keep a balance between ownership and buying from individuals, and that's a good thing.
For Market to Market, I'm Colleen Bradford-Krantz.
Next, the Market to Market report.
This week, the Fed said recent hurricanes are not expected to have long-lasting economic effects. All this spelled a mixed bag for commodities. For the week, December wheat improved 0.5 cents, while the nearby corn contract lost a penny. The soy complex continued an upward trend, pushing through recent highs as the November soybean contract gained 18 cents. December meal added $7.60 per ton. Despite hurricane losses, a glut in the cotton market continues as the December contract shed 61 cents. Over in the dairy parlor, October Class 3 milk futures ticked up 35 cents. The livestock market continues to run the gamut this week as the October cattle contract put on $3.83 and nearby feeders went $5.45 higher. The October lean hog contract dropped $5.28. In the currency markets, the U.S. dollar index expanded 31 basis points. Crude oil increased 22 cents per barrel. COMEX gold fell 27.70 per ounce. And the Goldman Sachs Commodity Index put on just over 2 points to finish the week at 397.95. Here now to lend us his insight on these and other trends is one of our regular market analysts, Dan Hueber. Dan, welcome back.
Thanks very much. Great to be here.
We're excited to have you, and in case you want to go over things again, you can download or listen to our Market Analysis and Market Plus podcast anytime online at iptv.org/MTOM. Now, Dan, let's start off by looking at the wheat market. Have we found a nice place of stability in here for Chicago wheat?
I think absolutely. You know, we've really been building a base for some time here. And again, I've maintained many times that, wheat is really that market that needs to kind of get that foundation built and start leading us back out of here, particularly for the corn market. And I think we've been in the process of doing just that. And a little bit disappointing that we couldn't quite get the December contract over $4.50 for the weekly close, but had pushed up to the highest point traded, I believe, since the 1st of August here today. And, really with very little other news out there. But, the trend's encouraging. But, when you're building a long, broad base like this, it's just patience is of the essence. I mean, it takes a long time before we can really start to turn that ship in the right direction again.
All right, turn that ship in the right direction. We're hearing that in at least all the feed grains. And when we talk about the corn market, one of the concerns I've heard from several producers is that it seems as though we are still busy selling last year's corn crop.
Boy, yeah, probably the theme of this last year is the lack of opportunities that we've really had. And unless you implemented strategies where you're selling options, outside of the range of this market, there has just been very few opportunities to actually do much as far as set a price on anything, old crop or new crop, and so many people on the new crop, I need to have a $4 bushel break even. Boy, there's been about 1 or 2 opportunities that you could have sold above that level. So just, kind of reminiscent of back in the mid-'80s when the markets were flat, very stagnant. We were certainly redeveloping a demand base, but, it took a long time to move through that period before we started to see enthusiasm again. So.
Now, we've got a question here from one of our followers on Twitter. This is from Marty in Buxton, North Dakota. And coming back to that physical grain movement, Marty's on Twitter at SatMonster. He wants to know, he says, the physical movement of cash corn seems to have no end. Can this be explained by last year's corn yield really being in that 178 to 179 range rather than 174.6 as USDA put out there?
And granted, region by region, that could be the case.
Okay.
When you looked at the September grain stocks, or that are coming up, or I should say what they projected ending stocks, I don't think the USDA was probably too far off a base of where they thought it was, but by no means was any less than what they anticipated. Yes, did we possibly lose a little bit in the livestock sector as far as usage there? Some competing products going on there that weren't really detected from the wheat. Yes, I think that would probably explain it more than anything. But, we finally had to come back and readjust to truly a $2 billion plus carry out on the corn market. So, even with the expansion we've seen in storage facilities, that's a lot of corn to carry into a new year.
It is. And, we can't seem to break out of this range. Corn market, we're making a push maybe for that 360 mark again on the December contract.
Correct.
Are we going to break free of that here during harvest season, do you figure?
Boy, we would have to, I believe, see something kind of out of the ordinary in the demand side to make that. Or, now granted, I should back up. Supply is still an element there, although we've kind of factored much of what I think of the supply and maybe overestimated what the supply is as far as where that new crop production is. But until we either come to more of a realization of what that is, that's maybe a little less than we're anticipating today, or see demand start to kick in, and it's kind of hard to really imagine that you're really taking hold until we get post-harvest.
So for producers that are out there, we're nosing into the cornfields today in a lot of the southern parts of the Midwest for anyway. Sure. How should they be handling this market if they're getting in and they're finding themselves undersold?
Here again, it's all going to hinge on what kind of storage capacity you have, what can you put aside. When you look at the basis levels as wide as they are, we've got respectable carry, actually in corn and beans both. If you have the bin capacity, you want to take advantage of that. Now that doesn't necessarily mean you need to store it unpriced. You probably want to sell the carry, take advantage of that. If you want to continue to be long, look at using another instrument, be it a call option or long futures, something along those lines. But certainly the market is giving us the incentive to put it away. Again, if you have the possibility to do it, take advantage of those carries in the market.
All right, well, now let's talk about soybeans, because that has been a fascinating story.
Absolutely.
For the better part of a past month. We're 50 cents higher on the November contract, a little better than 50 cents.
5 weeks in a row, higher closes.
5 weeks in a row, and now never happened before, is that correct?
This time of year, probably. Yeah,
okay. So now, great export sales reported earlier this week.
Absolutely.
Where does this thing top out?
Of course, $1 million question there, $1 billion question, I guess you'd almost say. And again, I think we're going to probably run into pretty formidable resistance once we get up towards that $10 mark. That looks to be in the sights of the market here at this point in time. You really look at the bean market for the last 3 to 4 years. Everybody has underestimated just how substantial this demand will continue to be in the bean market. I don't think China shows any signs of slowing up. Yes, there is a good availability of supply of beans in South America, but I don't think you're ever going to see buyers totally trust what's coming from that country just for political purposes, logistical purposes, those type of thing, which keeps that lion's share of the business moving towards us. Now, granted, recognize that the sales we're making right now, yes, they probably could be canceled, switched, if everything worked out well, but again, we are we have been traditionally the true supplier, the true reliable supplier of beans, and I don't think they want to turn their back on that.
Now, that being said, a lot of producers that I've spoken to are planning on just making bean sales off the combine. It's going to free up some cash flow. They're not going to monkey around with storing them. If they're doing that, and these prices, basis has remained relatively stable, even as the market has rallied, should they be looking to re-own in some capacity? Is there enough excitement built into this market that you'd feel confident with either a call strategy or an outright futures reownership.
And I want to say yes, but I don't want to say sell it and just automatically buy. Yes, play the range. If you're selling into a rally, we're pushing up at $10 plus on the beans, maybe sit back and allow the market to break back down a little bit. Some of the strength recently, now this is more psychological than anything, has been off of concerns of La Nina, the dryness in South America, or particularly Brazil at this point. So yes, I guess if that never changed, maybe the market's up and away on those kind of concerns. But that said, when you look at it on a little shorter term standpoint, we're getting relatively overbought, probably due for a correction. And yes, the harvest is just getting underway. So psychologically, you would think that's going to pull us back another time from here.
And as you mentioned, you look out at March, we've got the chance to sell beans over $10, $10.05, $10.04, around in there. Right. I want to take a look at the cotton market. We mentioned it just briefly earlier in the program. We've seen devastation across Texas, across parts of the Southeast, and cotton has continued to move lower. Are we getting close to putting in a bottom? At least this week, we were only 61 cents down rather than $5 we saw last week.
Correct. And again, here, if you can take cotton, crude oil, soybeans, corn, any of these markets, and you put a chart up and it's hard to really tell the difference from one to the next. We tend to push to the higher side of the range. If you really get lucky, you'll maybe take a week or two that you push outside of what's been, truly a 4-year trading range at this point. Cotton's there. Cotton is just in that same position. We had a great bump here 30 days ago, pushed up towards 77, 78 cents. Really looked like we were ready to try to challenge new grounds. All we really did was test the highs of the spring. The lower side of this December cotton market's been 67.5, 67 cents, 66.5 cents. We're back down in striking distance there, and I think as much as anything, yes, we need to kind of build that foundation once again. But you look at cotton, you look at corn, you look at wheat, the downside just seems extremely limited. But boy, it's testing everyone's patience to what's going to bring us back out of here.
That's true. And now, speaking of testing the downside, we've seen live cattle on basically a 4-month downtrend. We are seeing something interesting where futures are now back to leading the cash market. Cash trade was at 108 in the South earlier on Friday. We closed at 111. What's your thoughts there? What's shifted in that market?
Other than anticipation of what kind of demand we're going to see here moving ahead, outside of that, it's really it's hard to put a finger on it. Part of it's a technical rebound, absolutely, but it's the numbers don't seem to have shrunken up to the point where anybody's got to chase the beef all that much. Could it be something shaping up in the export market? We've talked now for months now about China's going to be the next trade here, that they've allowed beef in there. Maybe the market's telling us that that's finally going to come to fruition at this point.
All right. And then we had the cattle on feed report on Friday. Did we have anything that was too shocking in cattle on feed?
And again, I've been traveling all day, so I did not see the cattle on feed report, so I'm not sure what came out of those numbers.
All right. So we'll see what happens on Monday.
There we go.
Now let's talk about the feeder cattle trade, because feeders, they have been priced at a little bit of a premium to the live cattle trade for the better part of the past year. And we saw another big move to the upside, $5, almost $5.50 this week on the nearby feeder contract, and corn down here at this range. Can this market find any more of a topside, or are we getting close?
Here again, too, I think we're getting close. Yes, the low corn prices have probably been as great of a stimulus as anything in there that, I might as well walk this corn to the market as try to struggle in taking it out in any other form. Now, that said, I think you are back to the point finally where there's some margin that can be attained by putting cattle in the feedlot. So, but that said, we had to kind of narrow that in. For something too long there, you just saw nothing but red ink. But this rally in the fats has now at least moved us back to the point where you can put on a hedgeable product, get it in the feedlot, and hopefully not get too far out of balance from where we're finally back to some levels that make it work for everybody.
You bet. Keep the banker on your team by locking in some of those
preferably, yes.
Profits that are available. And now finally, we got to take a look at the lean hog market. There has not been a lot of positive news. I think we ought to. Yeah. Even though none of the hog producers really want to, we continue to see this market slide back down. Dan, my question, are we going to test last year's lows of that $46 range?
Oh gosh, we're in striking distance of it here now after this week. So it's, and again, this hog market time and again looked like it's finally finding a bottom. We push it on through. And, the unfortunate side is you look at the margins out there, packer margins are solid, so it's, if we want to start cleaning up any excess pork out there, it'd be easy to do if they start bringing that retail or the wholesale side of that down. But, you know, that hasn't been the case. I think they know all the cards are kind of in their hands here at this point. We seasonally, yes, we do look for a low as we move into October. It looks like it's going to be kind of a dramatic low at that. But on the same token, boy, there's just a lot of red ink. You know, one of the difficulties in the hog market is, I mean, just so many hogs are lined up on packer contracts. I mean, basically 1% of the hogs are not tied into a packer somehow or another, and you know, that really allows that to dictate what's going on in this market.
You bet. It's a captive supply.
Yep, absolutely.
Now, one of the things that we've heard about with regard to wheat, with regard to the pork market in particular, is the U.S. dollar. The strength of the dollar, at least a year ago, the strength of the dollar was hampering exports. You know, we bought the dollar index down 10 points since a year ago.
Sure. Yep.
Are we seeing that pay out in better exports? Are the end users taking advantage of a cheaper U.S. dollar?
You know, I think there's always a bit of a lag period in that. You know, even let's back it up to soybeans. You know, you think, well, gosh, it's lower dollar, and really the dollar is down about 10% from where it was on January 1. You know, I would say no. I don't think China's buying beans because I think the dollar's gotten into a better bargaining position. They're buying beans because they want to build up the inventory on beans. That said, I do think there is a tipping point. I think we're going to see kind of a delayed reaction there. That yes, we should see that export side start looking just a little bit more competitive as we move into the months ahead.
All right, we'll keep our eye on that. Dan Hueber, thank you so much for joining us this week.
Thanks very much.
That wraps up the broadcast portion of Market to Market. However, Dan and I will keep the conversation going, including answering more of your questions during Market Plus, available in podcast and video form on our website. And do you have thoughts or suggestions for the program? We'd love to hear from you. Send an old-fashioned email to markettomarket@iptv.org. Join us again next week as we take a look at a Midwest producer's partnership with an East Coast dairy giant. So until then, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content.
Wherever your operation takes you, or who you share it with, we'll be where we've been all along. With you from the word go. Proud sponsor of Market to Market.
Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today. And by Sukup Manufacturing Company. Offering a full line of grain drying and storage equipment and steel buildings, Sukup Manufacturing is on a mission to protect and preserve your crop and the tools that produce it.